Part 7, Double Entry Principle for Inventory. We are using the periodic inventory system to record the movement in inventory. Periodic inventory system is a system by which the inventory is physically counted at the end of an accounting period. There are two movements of inventory. One is increase in inventory and another one is a decrease in inventory. Increase in inventory is due to the purchase of goods and the sales return or return inward. So what is return inward? Return inward are goods returned to the selling entity by the customer. Okay, now what if the inventory is decreased? What is the reason inventory decrease? So the amount of inventory will decrease due to the sale of goods and due to purchase return or return outward. So what is return outward? Return outwards are goods returned by the business to supplier. And the effect for the purchase of goods. Purchase expense will increase. Account involved is debit purchase account. Number 2, sales of goods. Sales revenue will increase. So, credit sales account. Number 3, purchase return or return outward. The effect is purchase expense decrease. Account involved is credit purchase return or credit return outward account. Number 4, sales return or return inward. The effect is sales revenue decrease. The account involved is debit sales return or debit return inward account. Example number 6. Purchase good worth 2,000 on credit from Rohani Trading. So the amount of inventory will increase. Since the amount of inventory increase, the amount of purchase will increase. The amount of purchase expenses will increase. Expense increase, debit. The account to be debited is purchase or purchase account. In purchase account, the entry is made in the debit side. The date is January 6, particular is Rohani Trading, and the amount is 2,000 ringgit. Another effect, the purchase of good was made by credit, which means liability increase. Liability to account payable Rohani increase should be credited. In account payable Rohani Trading, the entry is made in the credit side January 6. The particular is purchases, which means that the purchase was made to Rohani Trading by credit amounted to 2,000 ringgit. Next example, example 4.12, 7 January, return good worth 100 ringgit to Rohani Trading. So, return good by the business to the supplier. Rohani Trading is also the supplier or the creditor of the business. Return good to supplier is known as purchase return or return outward. When the business return good, the expenses will decrease. So, decrease in expense is credit. The account to be credited is purchase return or return outward. In purchase return account, the entry is made in the credit side, January 7. The particular is Rohani Trading, which means that the goods are returned back to Rohani Trading. The amount is 100 ringgit. Another effect is when the business return back the good to Rohani Trading, the amount of the liability decreased by 100 ringgit. So liability decrease should be debit to account payable Rohani Trading. In account payable Rohani Trading, the entry is made in the debit side, January 7. The particular is purchase return, which means that this amount of 100 ringgit is made due to the purchase return made by the business to account payable Rohani Trading. Next example, 4.13, January 8, credit sale of 400 ringgit to Ali when there is a sale or credit sale to the customer. The amount of inventory will increase. So increase in asset, which is account receivable Ali, will be debit because the sale was made by credit. Therefore, Ali is becoming the debtor or the account receivable for the business. So asset increase is debit. In account receivable Ali, the entry is made in the debit side, January 8. The particular is sale, which means that the sale was made to Ali by credit amounted to 400 ringgit. And the next effect is revenue increase due to the sales, right? Okay, revenue increase should be credited. So account sale or sales account will be credited with the amount of 400 ringgit, and the particular is account receivable Ali, which means that the credit sale was made to Ali on the January 8. Next example, 4.14, January 15, Ali returned defective good worth 40 ringgit, which he previously bought from the business, amounted to 400 ringgit. Previously, the business sold good to Ali, sold good by credit to Ali, amounted to 400 ringgit. But on the next day, Ali returned back the good on the next day. Not on the next day, it is on January 15. The Ali decided to return the defective good worth 40 ringgit to the business. So this is the customer returned the defective good to the business, which is known as sales return or return inward. Return inward are good return to the selling entity by the customer, right? Okay, so when there is a sales return or return inward, revenue will decrease. So revenue decrease is debit, yeah. In the sales account, the entry will be made on the debits. In the debit side, January 15, particular is account receivable Ali, which means that the sales return was made by Ali, amounted to 40 ringgit. And in account receivable Ali, the entry is made in the credit side because asset decrease. Asset account receivable Ali decrease. So asset decrease is credit. Therefore, you can see the entry is made in the credit side, amounted to 40 ringgit. The date is January 15 and the particular is sales return. It means that Ali returned back the good to the business, amounted to 40 ringgit. And example 4.15, January 17, bought good worth 400 ringgit from Aladdin by check. Since there is a purchase of good, the amount of expenses increase Expense increase, debit, yeah? Debit purchase account. In purchase account, you can see here on the 17th January, there is an entry of 400 ringgit and the particular is bank, which means that the purchase was made by check. And the other effect is bought goods by check, means that you have to withdraw your money from the bank. So when the business withdraw money from the bank, asset bank will decrease. So the amount will be recorded on the credit side. In bank account, in the credit side, you can see here the transaction on the January 17, there is an amount of 400 ringgit due to the purchase made from Aladdin. Okay, so you just record it as purchases 400 ringgit because this is the purchase made by check. Example 4.16. January 18, return good worth 40 ringgit to Aladdin and receive a check for the amount. There is two effects here. So when the business return goods, there is an account known as purchase return. Purchase return means goods returned by the business to the supplier, which is Aladdin. Purchase return because when the business return back the goods, the amount of expense will decrease. Decrease in expense will be credited. Therefore, in purchase account, the entry is made in the credit side, amounted to 40 ringgit. The date is January 18 and the particular is bank. Okay. Since when the business return the good, the business get back the amount by check. Okay, next effect is asset increase, which is bank increase. Since the business return good to Aladdin and Aladdin give the business back a check amounted 40 ringgit, therefore asset bank increase. Asset increase debit. See in the debit side of the bank account, on the 18th January, there is the amount of 40 ringgit due to the purchase return made to Aladdin. Example 4.17, the double entry principle for inventory, and again, January 18, cash sale worth 240 to Alibaba. There are two effects here for this transaction. One is asset increase. When there is a sale made by cash, the amount of cash increase. So asset increase debit. And another effect is when there is a sale, the amount of revenue also increase. Revenue increase, credit sale. There are two accounts for this transaction, cash account and sales account. Cash account, the entry was made in the debit side, and for sales account, the entry was made in the credit side. For cash account, debit side, January 18, sales, the particular is sale and the amount is 240 ringgit, which means that there is a cash sale amounted to 240 ringgit. And in sales account, there is an entry of January 18, particular is cash, which means that there is a cash sale made amounted to 240 ringgit. Example 4.18, January 19, Alibaba returned goods worth 24 ringgit and was paid the amount immediately. Alibaba is the customer of the business. Therefore, when Alibaba, the customer, return good to the business, it is known as sales return or return inward. Return inward, in other words, means good return to the selling entity by the customer. There are two effects for this transaction. When the business paid Alibaba by cash, since the sale to Alibaba was made previously by cash, therefore Alibaba will get back his cash, right? So when the business returned back the cash to Alibaba, the amount of cash decreased. Asset decrease, credit. And another effect is revenue decrease. When the customer or Alibaba return back the goods to the business, the sales will decrease. So revenue decrease is debit. There are two accounts for this transaction, yeah. Number one is cash account and number two is sales account. In cash account, the entry was made in the credit side, because the amount of cash is decreased. Okay, decreased by 24 ringgit on 19 January. And in sales return account, the entry was made in debit side since the revenue is decreased by 24 ringgit due to cash returned to Alibaba, right? On 19th January. That's the end of part 7.